Hi, welcome to Chapter 7. Today we'll be talking about loans, student and consumer loans, and how you can plan for your borrowing. Okay, so here are our learning objectives. We're going to talk about various consumer loans. We're going to calculate the cost of a consumer loan, pick the appropriate source for your loan, controlling your debt, understanding alternatives to financing your college education. We're going to talk about consumer loans, the contracts, how much you're going to borrow, what you're going to pay back, interest rates, and we're going to look at this for using it for bigger purchases, um, and how debt and borrowing can easily get out of control. Okay, so consumer loans. These are loans for everyday people like you and me, and basically a consumer loan, some things we could think about is single payment versus installment payments, secured versus unsecured, variable versus fixed, and short versus long term. So let's look at the single payment versus installment loans. I think most of consumer loans and most of what we are used to is installment loans. But a single payment loan is what we sometimes call a balloon loan, where we pay back a lump sum uh, with the interest at maturity. So it's basically getting the money today, making no payments, and then say 5 or 10 years from now, we make one balloon payment where we pay back in one big check the loan and the interest. Now, this is not a very common type of loan, and it's very risky for banks and lending institutions to do something like this because they're not gonna get um, a stream of cash flows of interest and principal during a life loan like they would get for an auto or mortgage loan. Now, installment loans are much more common. So each time you pay, usually monthly, you're going to pay part of the principal and interest at monthly intervals. And this is something where we have loan amortization, which means each payment, the interest portion decreases and the principal portion increases. So this is the one thing about that people need to realize when you borrow money for a mortgage for a house for a 30-year loan. In the beginning of that loan, a majority of the payment is going to be for interest and a small percentage for principal. So it could be 80-20. 80% of the payment is going to interest, 20% to principal. And by the end of the loan, it's the reverse, where 80% is going to principal and 20% is going to interest. Now, the thing that's hard about this is if, say, you have a 30-year mortgage and after 10 years, you decide you want to pay off your mortgage and pay all your principal back. You would have found that after 10 years, you paid very little principal back, um, and it was mostly interest. So if you took out $500,000 to buy a house, after 10 years, hypothetically, you might still owe $465,000 after paying your mortgage for 10 years. These are just estimates. So it's kind of disappointing. That's why if you are going to pay an auto loan or a mortgage off early, you want to do it within the first 25% of that loan's life. So that way, you wind up saving yourself a lot of interest. So the sooner you pay those mortgages or loans off, if you can, the more interest you'll save. By the time the mortgage or auto loan is in the last part of its life, say the last 25%, um, you might as well just keep it because you're paying very little interest at that point, and there's no point in really paying it off early. Okay. Second decision, secured versus unsecured loans. So a secured loan is secured by an asset and typically has a lower rate for that loan. And unsecured is not guaranteed or secured by any type of asset. So for example, we're talking about auto and mortgage loans. So typically mortgage and auto loans come at a pretty low interest rate compared to unsecured loans. And that's because the bank, if you think about it, you could buy a $500,000 house with as little as a 5% down payment. So that's a huge amount of leverage in the loan, because the bank knows that the house is a very strong asset, an asset that typically grows in value. So even if at some point of the mortgage you default and aren't able to pay the loan back, they still have your house, which they'll sell. And 95% of the time, they'll make more money in the sale than you owe on your house. So it's very low risk. So that's why secured loans can afford to pay lower interest rates than unsecured loans, where there's no collateral. So if you default, the bank or lending institution has nothing to collect uh, to uh, pay themselves back, and they'd have to use some sort of legal action to try to get the money from you, which is never a guarantee. Um, Now, third decision, variable versus fixed rate loans. Well, so the fixed rate is pretty simple to understand. Basically, you get one rate and it stays that rate for the duration of the loan. It's not tied to market interest rates. So if you have um, a market where interest rates are looking to increase, which they do time to time, this would be a bad thing because as the market rates go up, so does the rate of your loan. So it's very dangerous, especially for mortgages, because you have no idea where interest rates will be, and especially if you got a mortgage in the last 10 years or so when interest rates were relatively stable, it would have made and low for mortgages, historically low. It would have made complete sense to get a fixed rate. Now, when they do offer a variable rate, sometimes it's attractive because the variable rate is usually less than the fixed rate. So they might say you can get a fixed rate mortgage today at 5%, but then they might offer you a variable rate mortgage at 4%, hypothetically speaking. So it seems like the variable is cheaper, but however, if interest rates double, say to 10%, your mortgage will your variable rate mortgage will probably double as well. So this could lead to unexpected higher payments for your mortgage that you're not prepared to meet. So variable rate or adjustable rate is a gamble, basically. Now, when they say the prime rate, this is the rate of interest that banks charge to the most creditworthy or prime customers. So this is why what we talked about last chapter, you want to make sure that you have the best credit score possible. So you get the prime rate, the best rate. This is a rate that's generally advertised. So this is the rate that they'll promote for their mortgages and their car loans. But if you come in to get that loan and you have poor credit, you're going to pay a much higher interest rate. That's why taking care, like we talked about last chapter, taking care of your credit and monitoring your credit score and trying to improve your credit score can save you thousands and thousands of dollars over a lifetime. Okay, let's talk about a convertible loan. So this is a variable rate loan that can convert to a fixed rate loan. So convertible loans are not that common, but basically there's a mechanic in there where you can at some point switch it from variable to fixed. And this is to alleviate some of the fears of when interest rates are looking like they're going to go up significantly, you may want to switch over your mortgage to a fixed rate. So typically in the contract, there'll be a conversion schedule of how to do this. But these loans are not often available to consumers. Fourth decision, the loan's maturity. Shorter term means lower interest rates and higher monthly payments. Longer term means smaller monthly payments and a higher rate. So this is something that you could more commonly see in an automobile. So you could take an auto loan for uh, 3, 4, or 5 years. So if you take a 3-year loan, 3 and 5 year loans are the most common for automobiles. So if you take a 3-year loan, your payments will be much more higher than a 5-year loan because you're paying the vehicle back over 3 years versus over 5 years. Now, the interest rate for a 3-year loan can be significantly less than a 5-year loan. So lending institutions, of course, would prefer you take a 5-year loan. They make more money on that than a 3-year loan. But in some cases, the car payments are significantly higher for a 3-year loan. So might want to think twice about that. But you definitely, with a 3-year loan, you'll definitely pay a lot less interest. So here are some things to understand in the terms of the loan. So the loan is nothing more than a contract. So they could really put anything in this contract that they want. That's why you should always read over your loan agreement. Some things that could be in the agreement could be an insurance agreement clause, which is basically saying that you're going to be required to have to purchase credit life insurance to pay off the loan in the event of your death. There could be an acceleration clause, which states that if you miss one payment, the entire loan comes due immediately, which is something you don't want. Um, so at the time, if you can't pay off the entire loan, the collateral will be repossessed and sold um, to pay off the balance of the loan. Sometimes, this isn't, a clause that's always in the contract, but you want to know if it is. So say, for example, this not uncommon for a car loan to have a clause like this. If you miss a payment of a car loan, they can come and repossess your car or make the full amount due. Deficiency payment clause, which is going to state that if you default on a secured loan, not only can the lender repossess whatever's secured, but the sale of the asset, if the sale of the asset doesn't cover what you owe, you're going to be billed the difference. And this typically doesn't happen with mortgages, but with an automobile, the depreciation is so quick in an automobile, you may, you know, have to owe money even after the vehicle's been repossessed. And often cases, when they do sell the asset that they due to a delinquency of payment, they're not so picky where they're trying to get the higher price. They're just trying to sell the asset as fast as possible. So they're not really concerned whether or not they're going to cover your loss 100%. Now, a recourse clause defines what action a lender can take to claim money from you in case of default. So the recourse clause will allow the lender to, garnish your wages, um, or maybe even go to your savings and checking accounts for the money. Okay, let's move on to here's an installment purchase a contract. So like we said that um, this is just an example of what a contract could look like. This is a boilerplate where they write in the amounts, and you'll probably see something very similar if you buy a car. And it's just going to lay out the itemization of what you're financing, the percentage of interests, the payments and the total payments, the number of payments, what the late charge could be, and then your signature or co-signature. So this is a fairly boilerplate type of installment purchase contract. If you get a mortgage on a house, when you buy a house, the contract's a little bit more um, detailed than say a more simpler loan. Now let's talk about some special types of consumer loans. So we have the home equity loan or second mortgage, um, which is secured on the equity of a home as collateral. So what does this mean? So basically, you buy a house, and in 10 years, the price of the house could double. Even though you've been paying off your mortgage and paying off your mortgage, that will also, the amount of principal you pay off will also be added to the equity value of your asset. So what this basically means is that you could borrow based on the value, additional value in your home above what the mortgage is at. So maybe your mortgage is at 300,000, but your house is worth 600,000. You could borrow 50 to 80% of the equity against your house and basically get, sort of a second mortgage. So that way, people often will do this to finance a remodeling of the house, repairs of the house, or really, you could use the money for anything, really. Um, so the advantages of having this, second mortgage is that you're going to get a lot of additional money, tap this equity when you need it most. Um, so the cost advantage arises because the interest on a home equity loan is generally tax deductible, um, depending on the current tax laws are always keep changing. But uh, and if you itemize or take the standard deduction, of course, which we discussed in a previous chapter, but this means that like a mortgage, the interest is tax deductible, so that helps make it a little bit more affordable of a loan. Um, so you can easily calculate what that equivalent interest would be compared to a loan where you can't deduct the interest. Now, the disadvantages of the home equity loan is that it puts your home at risk. So if you decide on a home equity loan, you have to remember you're taking on more debt that is going to increase your monthly payments. So now you're going to have two mortgages to pay. Um, and then also, when you sell your home, you're going to receive less equity because you have two mortgages to pay off on the sale of the home if you sell your home before these mortgages are completed. But it's a good source of money if you really need it and you don't want to sell your house, but you want to tap into your equity. It's a great source of funds. Something else you could do is if you don't want to take out a home equity line or loan, you can also refinance your mortgage, which means you can say the equity isn't, you have a certain amount of equity in your house, you can um, refinance your mortgage, hopefully at a lower interest rate. Maybe you extend the life of your mortgage, and or maybe you borrow more against the home and some of the equity in the home. So this is something else you could do to kind of adjust your financial situation. Now, if we talk about automobile loans, it's probably the biggest loan that you'll get in your life sooner than a mortgage. So usually your first loan is a new automobile or even a loan for a used automobile. And then once you establish that you're able to pay off that auto loan, it really does increase your credit score and also increases likelihood of being able to qualify for a mortgage. Now, how does an automobile loan work? Well, basically, it's only for purchasing an automobile, and it's typically somewhere between 2, 3, or um, 4 years. And it's possible, a lot of times they do offer a 5-year loan. It's not, which would be like 60 months, which isn't uncommon. Now, the risk to the lender is low because they have the automobile as collateral. So it's also a very competitive market. So not only do banks and credit unions compete to give you low rates of interest on auto loans, so do car manufacturers themselves that have their own loan facilities, and they sometimes will offer rates of 0 or 1% loans on new automobiles just to help improve sales. So an auto and so even if you may not need it, I would say resist the temptation to buy the car all in cash. It's better to get the auto loan, say a 3-year loan, pay it off. You can even pay it off early. Usually there's no penalties for that. And this will help establish your credit, build your credit score. And also, if you don't have to put so much money down directly in an automobile, you might be able to use that money for another investment. Hopefully that pays more in interest than you are paying on the loan itself. Now let's talk about the cost and early payment of a consumer loan. So the APR is the annual percentage rate, which is the percentage of cost of all finance charges over the life of a loan on an annual basis. So the Truth in Lending Act requires that all consumer loan agreements disclose the APR in bold print. So if you take the average annual financing charges and divide it by the average loan balance outstanding, you get your APR. Now, a loan disclosure statement gives the APR and the financing charges of the loan in a simple calculation. So basically, the interest is going to equal the principal times the interest rate times the amount of time. The discounted method, the interest is subtracted from the loan amount received. Um, so this is just how it's basically calculated. So you want to know, what's important to know is over the life of this loan, how much, you know how much the car costs, and that's your principal payments. How much interest will you be paying over the life of this loan? It's a good thing to look at. So a loan disclosure statement, this is another boilerplate that is just going to basically show you um, the rate of interest, how much interest you're going to pay, other types of fees. If there's a um, you want to also always understand if there's a prepayment penalty. So I would say never take a car loan with a prepayment penalty. This basically kind of locks you in to paying the loan and not paying it off early. Otherwise, you have to pay a penalty, which could be a lot of money. Um, now, so let's look at the a loan you should never ever take, and it's called a payday loan. So payday loans are basically a way of um, robbing poor people. It's really just outright theft almost. So this is how they kind of convince people to do this. Say you need money, and the only asset you have is your job. So they basically loan you money based on the collateral of your next paycheck. And then when you get your next paycheck, you have to pay it back. So it's a very short-term loan. You know, usually 1 to 2 weeks of a loan, but the annualized interest rates are incredible, anywhere between 100 to 500%. Um, so it's really a loan of last resort, and it's simply, you know, these are people that don't have any credit cards, that don't have any emergency funds, and this is really the only, you know, you're either going to miss rent or you're going to be starving, and this is the only acceptable choice. But you have to really um, never consider doing this because um, it's just such a ripoff. I mean, the annualized rate of interest and the fees associated with this are just ridiculous. You're really just kind of throwing so much money away uh, on these types of loans. And a lot of times they'll be offered, if you see those check cashing place locations where you see typically it says check cashing, and you'll notice that a lot of these check cashing places are in the poorer neighborhoods. They're never in the more wealthy or affluent neighborhoods. And these are places where you can cash your paycheck if you don't have a bank account. But these are also places that will typically be able to offer what they call, you know, a payday loan. Uh, so let's look at these by the numbers. Say uh, $15 per every 100 you borrow for 14 days. So the medium size of the payday loan is $350. So it's 391% annualized rate on a typical $15 for $100 for a 14-day period. So um, it's just, if you do that on the annualized percentage, it's just an incredible percent of interest. It's just terrible. Um, Now let's switch back over to the cost of installment loans. So with installment loans, repayment of both interest and principal occurs at, you know, say usually monthly intervals, and the payment levels are set so that loan expires um, at at a preset date, so we know what day in the future the loan will end. So installment loans could use either simple interest or an add-on method to determine um, what the payments will be. So the simple interest method is very common, and it's, you know, calculating payments based on an installment loan. So when we talk about the monthly payments, the uh, the installment loan remains the same each month. So you're paying the same amount each month, say $500, but the portion of the payment that goes towards interest declines each month. This is amortization as the loan progresses in age. Um, so in effect, you pay interest only on the unpaid balance of the loan, which declines as you gradually pay off the principal. That's why it could be very helpful if you make um, one-time principal-only payments. So for example, when I had an auto loan, every few months I'd make an additional payment of $1,000 or $2,000 just directly to principal. So if you have a $500 a month loan and you send in a $1,500, that extra $1,000 will go directly to reduce the principal, and that helps accelerate the payoff date of the loan. So, and we can determine the monthly payment on these installment loans by using, you know, a spreadsheet or a calculator online to easily calculate um, what these monthly payments would be at different interest levels. Now, the add-on method, this is a method. Let's see, we'll go back to that slide in a second. This is a method where we add on um, interest we could also call it interest installment loans. So interest charges are calculated using the original balance. These charges are then added to the loan, and the amount is paid off over the life of the loan. So the loan uses this add-on method. It can be costly and generally should be avoided. So if your loan is going to use the add-on method, I don't recommend it. So here are some examples. Here's an installment loan, $1,000 loan with interest calculations compounded monthly. So you're paying, oh, it's $1,000 loan. So you're paying $173 a month. This is your loan payment. Now, so if we look at the maturity, this is in 6 months. 12, 18, 24, which is 2 years or 30 months. So you can see as the the number of installment payments increases, the value of the monthly payment decreases. So if you're going to pay it off in 6 months, you're going to pay $173 at a 13% interest rate, or $174 at a 15% interest rate. But when you, if you space it out, you could see that the longer the loan, the lower the monthly payments. Okay, so let's look at a 12-month installment loan for $5,000. So here is month one. The starting balance is $5,000. Your monthly payment is $448. And this is what I was trying to say before. This monthly payment stays the same. This doesn't change. So you're going to pay your interest and then your principal, and then you subtract your principal and you get your new ending balance. So you see here that the interest you pay each month starts to decrease as the ending balance decreases, and your monthly payment to principal will start to increase. So this is a loan amortization schedule, and it kind of shows you the breakup between interest and principal. And this is basically how you could calculate it using the basic formula for the APR. And it's really just knowing your order of operations to calculate that loan. Now, let's talk about an early payment on an add-on loan. So if an installment loan is repaid early, you want to determine the amount of principal still owed. So the most common method is the rule of 78, or the sums of the last year's digits. So the rule of 78 determines what portion of each payment goes towards paying the principal. So if you look at, we're going to talk about this table here in a second, which has the calculations. Um, if we have that 12-month loan at $5,000 at 14%, according to the rule of the 78, more interest is paid in the early period because you owe more money in the earlier period since the loan hasn't been paid down yet, the principal. So an example in the next table, 7.5, we'll look at this. So here we have, the sum of all the month's digits. So this is the basic formula for step one, the sum of the month's digits. Step two, the sum of the remaining digits. Step three, determining the portion of the loan interest that will be avoided by repaying the payment earlier. Four, determining the dollar interest charge avoided by an early payment. And five, calculating the payoff value of the loan. So this is just basically um, a manual process of how to recalculate the loan based on an, an early payoff. Okay. Now, some of the mathematics here are actually quite simple, and we can easily do it in a spreadsheet or a loan calculator online, or last resort, a financial calculator. Now, how do you get the best rate on your consumer loan? Okay, so of course, if you getting a loan is like shopping for anything. You want to make sure you get the best deal. Um, so the inexpensive sources, of course, family. If your parents are willing to lend you money, hopefully at a 0% interest rate, that will probably be the most inexpensive source of funds. Then followed by home equity loans. Those are typically very low interest rate because your house is the collateral. Um, and maybe even if you have a life insurance policy, sometimes you can get the cash value of the insurance loans. But that's typically only available if you paid a lot of money into that insurance policy already. Some more expensive sources would be if you want to get a loan from a bank or a credit union. These are typically more expensive because these are usually unsecured, and you'd be getting more close to the market rate, but you have to shop around. Typically, credit unions will give you a much lower rate than a savings and loan or a commercial bank. The most expensive would be, you know, um, if you go to a finance company, that these are companies like a Payday Loan, or a company that they lend money, but they're not really a bank, and they usually look to take advantage of um, people with lower credit scores or less ability to utilize their local banking. Um, a loan from a retail store. Would be not so common, but it used to be like Leo, like you could buy your furniture credit on credit or your TV on credit and you pay back the store. Typically, these retail stores don't offer any financing anymore. They have their own credit cards that they'll offer you, and that's the way of financing their products rather than the store taking on the lending itself. So now, of course, you always want the best rate. So if you're gonna, how are you gonna get the best rate? Well, um, of course, it's all about your credit rating. So the less risky you are to the lender, the lower your rate will be. So if you have a good job, a long hit, you've worked at a job for a certain number of years, you have other assets like a home, or bank accounts or investment or a 401k. This makes you a more financially stable person. And specifically, most importantly, if you've worked on and increased your credit score. So if your credit score is above 750, you're going to get a better rate of your loan. Now, also, if you want a lower rate, uh, variable rate loans are usually lower rates, and it's because it's less risky to the lender. Because if the cost of borrowing goes up, they can increase the cost of your loan. The shorter term the loan is, the less risky. Because what's the possibility of someone being able to pay off a loan for 30 years versus 5 is much greater at 5 years. The risks. Collateral, the more collateral that is attached to the loan, the lowers the risk, it lowers the rate, and a large down payment. So you know, if you do buy a house, having a 20% down payment will make the cost of the loan and the cost of owning the house much less. So here's the question again. Should you pay in cash or should you borrow? So you know that debt can be expensive and it's just getting more expensive that interest rates are increasing. So, um, so really what should you do if you have the cash? Should you buy a house outright in cash or should you take the loan? Um, so now borrowing usually makes sense when you're buying a house. So if you had $500,000 in 2010 to buy a house, and you bought that house in cash and didn't take out a loan, yes, you'd save a lot in interest. However, if you put that 500, if you took a loan out in the house at a 4% interest rate, and you put that $500,000 into a stock-based uh, a stock-based say mutual fund, by today you could have got a 300% return. So that 500,000 would have turned to 1.5 million. So you could see the drawbacks of putting all your money into buying your assets without, big assets without borrowing. Borrowing is oftentimes could be a good use of your money if you're borrowing at a low rate of interest because you can invest at a higher rate of interest. Or if you're borrowing, especially for business, if you have to borrow, if you're borrowing to open your first location and you have enough money then to finance that business. And perhaps you can get a second loan to open up a second location. So maybe the choice is open up one new location with cash or two locations, the combination of cash and borrowing. So the more locations you have, the more money you're going to be making. So borrowing often outweighs the costs and makes sense for a lot of purchases. So it's not a bad thing to borrow money, and typically I would recommend borrowing for an automobile or specifically also a home. And typically, it's better to borrow for a home than pay rent because when you borrow for a home, it typically locks in the rate of increase. The mortgage is does the rate you're paying to pay your mortgage doesn't increase for a fixed rate loan. So it's a $2,000 mortgage. So when I first bought my house, um, to rent the house cost $2,000 a month. To buy a house cost $2,000 a month. Then 12, 14 years later, I'm still paying $2,000 a month to live in the house, but now rents on the similar house are $4,000. So it is also a good way to control costs. So now speaking of controlling your use of debt. So here you have to make sure that you determine how much debt you can comfortably handle. You want to make sure that your debt doesn't become a significant portion of your paycheck. So you have to figure out where you're comfortable and have enough money left over to live your life. Um, and this changes as you get older and make more money, or maybe you get married and you have two sources of income, you can take on more debt. So so As you get older, though, once you pass your initial, you take on a lot of debt in your 20s and 30s as you're buying cars and houses, and then once you get closer to age 50, you start reducing that debt as you're paying off your mortgage, as you're getting extra money to pay off some of your borrowing. Um, but there are several tools you can use to control your debt um, commitments. And one thing, the biggest tool is just knowledge. You want to know where you are. So using this debt limit ratio, it's a percentage of your take-home pay committed to non-mortgage debt. So we're going to look at just non-mortgage debt, all your debts outside of a mortgage. So your totally monthly non-mortgage debt payments would be like your auto, your personal loans, your automobile, your credit cards, divided by your monthly take-home. So this will give you a percentage. Now, the ratio should be below 15%. When the ratio reaches 20%, additional debt should be avoided. So this is just a guideline. It's different for other people, but this is just something to give you an idea of where you are and your debt to pay ratio. Now, um, we talk about this debt resolution rule. So this rule is used by financial planners to help control debt obligations, excluding borrowing associated with education and home financing. Typically, you don't want to look at the education and home financing are just too necessary borrowing. Um, but so once we exclude those, we're going to force you to repay all your outstanding debt obligations every 4 years. So the logic behind this rule is that the consumer debt should usually be short-term in nature and not last over 4 years. So ultimately, it's easier to manage your credit card debt if you think about it in this more short-term idea. Um, so you want to look at your credit cards, your car loan, all these short-term debts is something your goal is to pay off within every 4 years before you take on new debt. Now, controlling the consumer debt, make sure it fits within your goal and budget. So this is where you have to really look at your financial goals. The budget, the money you make compared to what you're trying to do with this money, get a better idea if it's working. Understand how costly the consumer debt is, knowing that there is a big cost to this interest that you're paying for your credit, especially credit card debt. It's such a huge cost that credit cards are definitely not free money, and you want to try to be able to pay off all your balances at the end of each month, so you don't pay a lot of interest on this credit card debt. Um, Now, borrowing limits your future. So you're borrowing from your future pay. So your financial flexibility is more constrained if you borrow a lot today. Now, when you start to get in financial trouble, usually losing a job is something that can lead to financial trouble if you don't have an emergency fund, or just abusive overspending on your credit cards and just ignoring it to the point where, you know, the interest payment and principal payments on your credit cards are consuming up most of your spare disposable income. So you have to really keep on top of it and never be lazy about monitoring, budgeting, balancing, and reviewing your finances. It should be done monthly. Here's a quiz you can use. Um, Answer yes to any of these questions, you might be in financial trouble. So having no savings, that's a danger sign. Um, do you know what to expect on your credit card statements? Is it just you're spending, 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 have no idea what the balance is? Now with these apps, each credit card company has their own apps. You could check your balances daily and just get a better idea of where you're at. Um, Now, if you're carrying credit card debt month to month, that's a bad thing. You're wasting money on interest. So are you living without a budget? That's a problem. Do you not have health insurance? Because health emergency if without health insurance, can really put you in a financial crisis. Um, are you borrowing from one lender to pay another? For example, are you trying to take out a new card, transfer the balances from your old credit cards to the new credit card? These tricks may help you out in the short run, but it's going to be more expensive in the long run. Um, so you can read over this list, and if you find any of these things are common with you, you may be in financial danger or may need to reassess your borrowing. Okay, so what if you can't pay your bills? um, so this is where the budgets come into play. um, You want to budget and control your spending to make sure that you can always pay your bills. And you need to use some self-control of your credit. Now, if you do get to a point where you can't pay your bills, you should definitely contact the creditor and explain to them what's happening, and let them know, like, they will work with you. Oftentimes they will work with you. They might give you a grace period. They might um, give you different terms. So always talk to your creditor. Don't let it be a surprise to them. Let them know you're struggling. See what they can do for you. You can also talk with a credit counselor. This is someone, a professional that can help manage your credit for you and make a plan out. In some cases, help you to repay your credit cards and organize. Not really a bad thing to do if you're really in and over your head. Um, Make sure that any future borrowing you do it in an inexpensive way. You can also do a debt consolidation loan. This is basically where you can take a loan out to pay off all your high costly debt. So you take a loan out with a lower interest rate and pay off all your debt. Uh, this is something that you could do with student loans too. After you graduate, you may have several different student loans, all at different rates of interest and high rates of interest. And you can, oftentimes there are plenty of places that refinance your student loans at altogether at a much lower rate and pay off all these high interest loans or repackage it with a new lower monthly payment. As a last resort, you can do something called bankruptcy to wipe out most of your obligations. Not all obligations will be wiped out. For example, you can't use bankruptcy to erase your student debt. But bankruptcy might be something that if you get into a position where there's a job loss, a divorce, a major illness, and you just really can't afford to pay off your credit cards or certain other loans, that this bankruptcy might be something you might want to pursue, which gives you a second chance to erase most of your debt obligations and start over. It does come at a consequence because it would make borrowing much more difficult in the short term, but in many cases, it's a way of salvaging your financial life. So it's something that you should think about. Now, the most common types of bankruptcy, personal bankruptcy, would be Chapter 13 for the wage earner plan, or Chapter 7 for straight um, bankruptcy. So let's talk about the Chapter 13. So, so you must have a regular income. So secured debts of less than $1 million or $1,184,000. This changes every year. This is what it was stated in 2017. Unsecured debts under about 400,000. Uh, so for individuals, this Chapter 13 bankruptcy provides relief from harassment from debt collectors. So this basically means they can't come after your assets, they can't harass you. And for creditors, Chapter 13 provides a controlled repayment by the court supervision. So basically, the courts are involved. They look at how much money you're making, they look at your debts, and then they'll say, okay, here's what we're going to do to help you. They're going to design a payment plan or repackage your debt in a way to meet you that you'll be able to meet your obligations. Um, so for your creditors, they're going to get some kind of repayment for your debt obligation under the court supervision. It means relief for you, going to be relief from credit card or bill collectors hassling you. Um, Now, in some cases, this can help reduce the outstanding debt that you owe. It all depends on how it goes in the courtroom. Now, a straight bankruptcy can eliminate debts and you can begin again. So, this straight bankruptcy, or what we call Chapter 7, um, is a more severe type of bankruptcy. The individual who doesn't have any possibility of repaying the debts has the opportunity to eliminate all these debts and begin again, with certain exceptions. Um, but it varies between which state you're living in. And the total amount of the exemption is variable too. So, uh, in opposed to a Chapter 13 bankruptcy, you have to pass a certain means test, which determines if your disposable income is lower than your qualified monthly expenses, and you must own very little property other than the basic necessities, which means you don't have a lot of assets they can attack. And it means that it determines if you're running, if you're how able you are to pay off your debts, and if you meet a certain threshold, um, then you'll be able to do the Chapter 7. Otherwise, you'll have to do the Chapter 13. Um, so you would really have to get a lawyer to see which one do you fit in, the Chapter 13 or the Chapter 7. And of course, it costs money to have a bankruptcy. You have to pay money to a lawyer, you have to go to a court. It's not an easy or short process, and typically should only be used when you're in a really extreme situation where you just can't pay your debts. Uh, and a credit counselor can help determine whether or not this is right for you. Now let's move over something that more immediately might affect you, which is student loans and paying for college. So a lot of students take these student loans and they don't necessarily really understand what they're doing, what their obligations are. Um, so you really need to understand the consequences of your choice of school and major. So if you're in a major like business, typically business hires all the business students that graduate and you'll have enough money to pay off your student loans. Other majors may be more difficult to translate into a job upon graduation. So you want to understand what is the full cost of school and how much can you borrow and can you borrow smarter? So, which means don't just take any loan offered to you. Make sure you only take loans that, or take loans first that offer the lowest interest rate. And you may consider working or looking for other sources like scholarships or grants or family members to help reduce the borrowing costs. And while you're on campus, you want to manage your money. You just don't want to keep borrowing, making loans just to pay for things you may not need. For example, you may not need to live on campus. Maybe you can commute or choose a school closer to where you live, and that can significantly reduce the cost of school if you're not paying for dorms. Um, you may want to look at how you consume on campus. Meal plans may be a good option. They may save you a lot of money, or they may cost a lot of money. You have to look at how these meal plans are structured. Um, and you want to be able to repay these student loans without really sacrificing a lot of your life after college. So you really want to understand as much as you can of these student loans, what the obligations are, and uh, how you're going to be able to pay them back. So if you look at, here's a chart that looks at earnings, unemployment, and rates by educational attainment. So here's the unemployment rate. So of course, getting master's degrees, professional degrees, or doctorates, lower levels of unemployment, higher levels of wages. Now, the bachelor's degree is probably the best place to want to get to because that gives you the most bang for your buck with a pretty low unemployment rate and a pretty decent weekly pay. And you can see that dropping out of high school is the worst case scenario. So this clearly supports why we pay so much for education because it really does return more opportunities as far as employment and more weekly wages. And that's why borrowing for school is smart if your choice is go to not go to school because you can't afford it or go to school with loans. It's always better to go to school with loans because the payoff, the return on those loans as far as your lifetime earnings is greater. But you should still do research of what salaries you can expect, what job opportunities are upon graduation. And you don't want to take a huge amount of debt on if you're not going to really have the potential to make a lot of income. So it's just not a good payoff if you take certain majors that are not likely to return any type of decent income. And now you owe all these loans on your. It's also the type of school you go to. If you go to, you may be able to save money by going to a community college or a public school versus a private school, living on campuses versus not living on campus. So there's a lot of choices you can make to impact your total debt. So you just have to understand, these choices you make and how they can impact your future. Now, many of you, I'm sure, have compared financial packages between colleges. A lot of times, public schools won't offer a scholarship, but private schools will. But don't be fooled by this because the private school might cost $100,000 and they're going to give you a $50,000 scholarship. You still have to pay $50,000 a year, where a private school might cost $8,000 a year or $10,000 a year and provide no scholarship. So you're still winning out with the public school versus the private school. However, if it's a very prestigious private school, you'll probably make more money upon graduation than a public school. So there are pros and cons to how you look at this. But you want to apply for the federal aid first, TAP, Pell, look for these state and local grants and scholarships. Use any tax credits and deductions to your advantage to offset income taxes you may owe. So you really want to look at all the particular ways you can restructure your position, your debt, your income to make the college costs as less as possible. Um, and just understanding um, how all the financial aspects of a college works is really important. And of course, there are things you could also do, such as if you want to become an RA on campus, that can reduce or eliminate your dorming fees. If you want to work on campus, there are a lot of campuses that will hire students to work on campus. And you can also, there are things that you can do, such as, if your parents or you have a 529 plan, this can help save money and reduce your taxes to pay for college. There are certain tuition plans where you prepay and you can get uh, multiple years of tuition at a greatly discounted price. There are, of course, college savings plans and, college savings accounts. So these are different things you should think about. So just to go into these in a little bit more detail, the 529 is sort of like a 401k where you could save for college, and this will reduce your tax burden. So most states offer this 529 plan as an advantage, but it's something you have to do before you go to school. You have to be saving, or your parents using this account to save money for your school ahead of time. Now, the prepaid tuition plans, this allow college savers to purchase, credits at a college university for future tuition. So it's a way of locking in the rates today. So if the rates increase, and most of these sponsored plans have a discount for prepaying. Um, the tuition. So even though it's a lot of money up front, it can greatly reduce your costs in the future. The college savings plans, um, you know, it's just establishes an account that for the sole purpose of really paying for eligible college expenses, tuition, room and board, um, and then withdrawals from these savings plans can be used at any college or university. Um, and this could be something that a parent or a guardian can set up, or a grandparent can set up. So among the biggest advantages of these 529 plans over the college saving options are the tax advantages they offer. So earnings grow tax deferred, and withdrawals are tax free when used for the qualifying expenses. So there's another way to try to leverage tax deductions to help make college more affordable. So anyone can contribute to a 529 plan. There are no income limitations, but for most wealthy individuals, 529 plans one of the few available tax advantages that they can easily take advantage of without these income limits. Now, the Coverdale Educational Savings Account, this allows you to make an annual non-deductible contribution up to $2,000 a year, uh, designed uh, sort of like an investment trust account. And then there are contributor income limitations. The account will grow free of federal income tax, and tax-free withdrawals can be made. So the advantage here is used for elementary and secondary as well as higher education purposes. Uh, and the contributions have to stop when the student becomes 18. It must be used by the time they're 30, and any leftover money will be charged taxes as a penalty. So there's another just type of this, but a lot of these plans, you know, you have to do before you go to college. Here's a comparison chart of uh, these three different types of saving mechanisms to pay for college. So you can kind of read this over. A lot of this I already kind of covered, but again, if you're already in school, it's probably too late to use these strategies, but maybe when you have children who are going to go to college, these would be some things you might want to think about to help finance that college tuition. So college tuition is now something that you should start financing for your child as soon as they're born. So and it makes college a lot more affordable because you can put money away every year for the first 18 years and get growth and return on that money, and hopefully reduce their college expenses at the time they're ready to go to school. Okay, so let's move over to federal student loans. So the Department of Education is your lender. So the interest is fixed over the life of these loans. And these are some of the best loans to get. Um, they are, subsidized by the government. And, if you look at the Perkins loan, it's a school-based loan program for undergraduate and graduate students who have exceptionally poor or a lot of financial need. The direct subsidized loans are made to undergraduates who establish financial need. Direct unsubsidized loans are made to undergraduate, graduate, or professional students. Now, what's the difference between subsidized and unsubsidized? If it's subsidized, the government's going to help pay for some of that interest or lower interest rates. The unsubsidized means the government's really not going to contribute much to it and the rates will be higher. And of course, you have these direct plus loans, which are made to graduates and professional students, and direct plus parent loans, which are made to parents of dependent undergraduate students. So basically, your parents can actually borrow money for your education as well, and this resides on your parents borrowing. Um, Direct consolidated loans, which allows students to combine all of their eligible federal loans into one big loan. So there a lot of federal loans is where you should go to first because they're going to provide you the lowest rates for the highest return on your student loans. Now, as far as private loans, there are plenty of private loans that you can borrow money from after you've used the limits of your federal loans. Commercial banks, credit unions are going to offer these, but usually at higher rates of interest than the federal loans. And they generally don't offer the deferment or the forbearing options that some of the federal loans have. So to get, especially if student loans are going to be canceled or reduced or deferred in the future, the federal loans are the ones that usually have the biggest benefit from those types of governmental programs. The private loans, they're much more costly and they're less flexible in the future. So here's a quick chart. Just look at what you need to know, the difference between the federal and the private loans, the benefits, the risks, and how to repay. So this is a good chart to kind of just refresh if you're taking a combination of federal or private loans. Interest rates are probably the biggest thing. Is the interest rates are much higher in the private loans, and hopefully you don't have to dig too deep in those private loans when you're going to school. Now, managing your money responsibly, a couple ideas on this. One, you want to um, choose a bank with the lowest rates, which typically is going to be a credit union. So seek out a credit union first before you go to Chase, Bank of America, Citibank. These banks are usually they're public companies looking to make profits from their customers. A credit union is a membership and organization where percentage of the profits are channeled back to the investors or shareholders, people who have money in the bank. So they typically are going to have much lower costs. Use direct deposit. Direct deposit is a great way if you have if you have a job or income, to just put that money into an account, and it makes budgeting a little bit easier. Now, as far as repayment of your loans, um, when you repay your loans, you basically have a couple different options that you get the standard repayment, which is a 10-year term, which is pretty. This is the first place your loan is going to be placed in this standard repayment, where you just have 10 years to pay off the student loan. Now, if there is an extended repayment, you can move this up to 30 years. Income-based repayment, which is if you don't make a lot of money, they may um, look at adjusting your loan with lower monthly payments for based on your income. And if you're graduated, you have to start monthly payments, and maybe you can start them at a lower. You kind of gradually do the repayment where the repayments rates start lower, and every 2 years they start to increase for a longer term. So there are many different repayment plans for your student loans. Now, deferment is something if you're enrolled at least half time in the school, or you're unemployed, or certain hardships. You can postpone the payment of your loans up to 3 years without accruing any interest. And if there's certain economic times like um, in the last couple of years, the government was deferring student loans due to the pandemic and environmental uh, issues, not environmental, economic issues, and they kept extending this deferment, which means there's a number of years where people on their student loans were having to pay or accumulate interest. Now, forbearance is, delayed payments due to illness, financial hardship, residency requirements. Um, so you can stop making payments temporarily for a certain amount of qualifiable reasons. Um, now, the interest still accrues, so it's not always. Um, it's a good temporary thing to do, but not for long term. And remember that the if you do get married, you should talk about your credit card debt, your student loan debt. Make this all out in the open before you agree to get married. Um, and also, having a lot of loans makes it difficult to, get an apartment, get a car loan. Um, so you want to make sure that you're open and honest about what your debts are and that you work together to improve them if you can. Okay, let's summarize this chapter. So basically, we talked about consumer loans, uh, what they're all about, what type of consumer loans you can get. We talked about the cost of loans, the financing charges, interest payments, processing fees, um, insurance fees. We talked about different sources of loans, and we're always looking to get the best rate of interest. So for a car loan, don't just go with what the dealership offers you. See if you can get a better rate at the credit union. We talked about how to control your borrowing and how to resize your debt to fit in with your lifestyle and financial plan. And the key thing here is understanding and knowledge about what you've borrowed, what you owe, how much you make, and your ability to pay off your loans. And it's often, a good thing to have a tight budget and advance the payments of principal on your loans to shorten their durations, and understanding the rule that school and your major play in your future income and your future ability to pay off your student debt. Understanding the different methodologies of utilizing, tax advantage accounts to help pay for college, or looking for scholarships and grants, or borrowing money from relatives at zero or lower rates of interest to help reduce the overall amount of borrowing for college. Um, and how you should really take advantage of any student loans that are offered by state and governments to get the lowest available rates of interest, and always be on the lookout for additional programs, additional grants, scholarships, anything that can help reduce the cost of college, whether it's becoming an RA, getting a part-time job, um, things of this nature. Okay, so that's the chapter 7 on student and consumer loans. I hope you learned something from this, and I'll be talking to you soon. Thank you.